Good evening, everyone. Welcome to Admiral Markets webinar. Thank you for joining us today. Of course, today's focus is an educational topic, looking at signs that a setup might not work as well. That's our focus for today. But before we dive into today's topic, be aware of these disclaimers. First of all, that this webinar and later on recording is shown to a global audience, may not be suitable for everyone. Take a look at admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity. Also, please be aware that trading foreign exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, Nenad will be joining me, of course, later on in just a few minutes. He'll show his side of why he thinks setups might fail. First, I'm going to dive into 7 of my own basically points that I wanted to talk through with you, and then I'm curious if you have any of your own that you might want to add. So by all means, please feel free to use the chat and let me know what you think and which ones you think might be missing in this list. First of all, 7 signs. Number 1, not necessarily in sequence, by the way, but hanging on to the trade and hoping for the best happens to so many of us. And when we enter and we keep in the trade, and our prospects do not look that good, then it's very difficult for us to let go and accept a break even or small loss. And it is difficult for us because from a psychological point of view, it's a lot easier to accept, let's say it's very difficult to accept small losses or any loss. It is very painful for us, and it probably doesn't matter as much if it's a small or big loss. I mean, of course, a big loss will certainly hurt our trading capital a lot more, but from a psychological point of view, it's interesting that the difference might not be as big. We are not easily pleased with the profit. It is not the same kind of stimulus in our brain. It doesn't give the same effect or impact as a loss has. A loss has a lot more, lasting impression on us. So that is just a bias that we traders and humans have. By the way, not only in trading, but that's with everything. We'll do a lot more our effort for basically avoiding $100 loss, let's say, than doing our best to make $100. That's just the way of viewing things. So for us to accept a trade that has not gone well is just a very tough barrier for us. Even though the risk might be 1/10, let's say we have a trade on that is $50 risk, and the trade is at -5. It is very difficult to, from our perspective, to take that -$5 loss because it's just engraved in us that it is a loss. So we rather hang into the trade and hope for the best and hope for a turnaround. But the longer it takes, in my general observations, the less likely it is to move on. Now, there is, of course, you don't want to give up on the trade immediately. That's another sign of trouble if you do. We'll talk about that in a second. But there is a border where you want to have a certain point where you say, okay, till here I have patience, and after that I want to be a bit more demanding. I want to be less dependent on a hopeful recovery of the market. Let's say if we look at this chart here, for instance, that we take a short somewhere in this cluster in the middle, all right? And if you take a short there and price is not moving our way, it might be very wise to actually exit instead of just hoping and waiting for the best. In fact, if the trade goes our way, there's always the potential opportunity to rejoin the trade later on, right? If you get more confirmation or if you get a new confirmation that things are going your way. There's not necessarily any rule that says if it meets at least your trading plan, then it should be fine. All right, so let me give you market there in with my little cursor here. All right, there we go. Right here. There we go, right there, for instance. If we're waiting for a short, for instance, it takes a bit too long, that's fine. to exit. Now, we don't want to get out too soon, and we'll talk about that in a second. I mean, if we're in the long here and we are waiting for that up move, and we think that there's enough time, we've got momentum here, we don't have to exit right away after 2 bars. There is a certain border. Typically, with 5 to 6 candles, you're doing pretty well. Sometimes it can be a bit more. It depends on the situation. This is a bit of a bull flag. Those can take a bit longer. But if this turns into, for instance, more than, let's say, 20 candles, right, 20 hours, then you might be wondering what's going on. It could be a big consolidation, and you might even want to exit the long, right? Because the long is at the moment with the momentum, so you could have a bit more patience. Short might be a bit more against the momentum, and therefore you want maybe less patience. All right, ignoring failure of a breakout. For instance, here you see prices trying to push above the double top, but fails. We see a strong bearish candle. Well, that could be reason, of course, not to hang in there and just cut the loss short or take some profit, and not basically sticking into such a trade too long is sensible too. Many times when we're in a breakout trade and it just doesn't go well, we tend to get married to the trade just a tad too long, and we think that there could be maybe still a continuation, and etc. So no, we don't want to ignore failures of breakouts. When we see a failed breakout, typically it is good to exit. All right, let's go on. Nervous from very first minute the trade is open, 0.3. So that's basically the opposite of number one, right? Hanging on for too long. This is getting out too soon. So we could have, in theory, we could have both issues. Typically, depending on your character, you're going to have one or the other. Most of the time, either you get out way too late or you get way too early because of nervousness. If you get out way too late, it's because of hope. Here, in this case, we just, as soon as we enter the trade, we, are a bit sweaty. Our palms are getting sweaty. We're getting, our forehead is sweaty, and we want to, have the profit as quickly as possible. But we know in the Forex market, Murphy's Law, if we want a fast trade, it's probably not going to happen. In general, of course, trades do take some time to develop it anyhow. So even if Murphy's Law does not exist. So that's something that we have to reckon with. It is going to take time for a trade sometimes to develop. So if we're entering on an hour chart or a 4-hour chart like this example, and we expect a move to continue within 5 to 10 minutes, it's absolutely unrealistic. All right? It could happen by coincidence, but we can't count on it. We shouldn't count on it. So it's out of whack. If we're entering on a time frame like an hour or 4-hour, we got to keep watching it on that time frame. That is generally the best, and you want to give it a couple of candles, right? So if it's an hourly chart, you want to give it, at least 5-6 hours typically. All right, at minimum. These are just general guidelines. It all depends, of course, on how your trading plan is set up, etc., how your system is working. And I don't want you necessarily to break your rules because of what I'm telling you now. These are just generalizations that I've observed as part of my trading plan. Let's take a look, for instance, here you can see, let's take a look at this first arrow right there. So let's take a look along right there. So 1, 2, 3, 4, 5, 6, 7th candle basically is the one that goes, right? Here, the 3rd candle. So it sometimes varies, but obviously we are not waiting 20 candles, for instance, right? So that's something to deal with. So but in any case, you also are not exiting at the first candle right here, because if you do, you didn't make any profit. I didn't make any profit, right? Because those candles didn't go anywhere. They go flat, and if I exit within 5 to 10 minutes on this 4-hour, these are 4-hour candles, by the way. So on a 4-hour, we have to have even more patience because 1 candle is 4 hours. 6 candles is a day. So you got to have a bit more patience. You cannot be nervous. Well, you could be nervous, but you have to manage it somehow. Otherwise, that trade is never going to go our way. All right, point 4. Maybe a no-brainer, but yeah, no preparation, no plan, only going with gut feeling. That's not going to give us any long-term sustainability or any consistency. All right. So yes, trading plan obviously very important. We need to also do our preparations within that plan. If our plan says we're going to look at daily candles before trading, we need to analyze those, then we need to do that, right? There's no if or buts. We got to follow that, and there's no voluntary choice on that. Unless you write it in your plan, you know, occasionally I want to take a look at the larger picture for the trend, fine, right? But you got to document that. We got to prep. We got to have a plan. We got to be prepared. Gut feeling is something that is a bit undescribable. You know, when and what and how much do you use that? The more experience you got, the more, in general speaking, it does become a bit more valuable because the gut kind of combines all kind of experiences that it basically gets out of our memory database, right? As we trade and we collect memories and patterns from all these experiences, and subconsciously our brain is connecting those and is making patterns that we might not even be consciously aware of. So subconsciously, we could actually be informing ourselves of what's going on, and that could translate into a gut feeling or gut thought that might warn us of something. But that often, you know, you need some experience for that, because if you don't have experience, then the brain has not had the time to make connections when we're sleeping. The brain is sleeping and resting. That's when we get those connections. If we don't have that experience, if we're not engaged with the trading, then we're not going to have that. You cannot get those connections if you're not engaged. You have to be engaged. You have to be passionate in a way about it. You have to be really working with the material. If you are looking at the charts once every 4 days for 10 minutes, then that gut feeling that you think you might have a gut feeling, but it is not. I'm sorry to disappoint you. That is not a gut feeling. Then in that case, that's built upon pattern recognition of the subconscious mind. You got to be a lot more involved than that. How much? I don't know exactly where the border is, but it's not 10 minutes every 4 days, unfortunately, or every 5 minutes 2 weeks. No. So yeah, you have to be more involved. Then you do have that gut feeling. It could be very useful because of the things I just mentioned that could warn you. And then it is occasionally good to use a bit of discretion in that and go with that. It's not always going to be working out, of course, perfectly, but it could have value. All right. So the last 3 points, and then we'll dive into some charts to take a look in more detail about these things. Point 5, failure to see signs of false breakouts. I'm meant to say, let's see. I meant, okay, 2 and 5 are excellent, the same. I meant it the opposite way, with probably 2 ignoring a breakout. So if you're taking a reversal, then there is a breakout, you stick to that trade. All right. So if you're looking for a false breakout but you don't get it, you don't want to hang in. If you're looking for a breakout and it turns into a false breakout, you also don't want to stay in. So that's what I meant. It's the opposite. Point 6 is breaking your rules and then second doubting that and second doubting that. That could be a pretty nasty spiral, and that leads to revenge trading as well. So once you break your own rules, you're kind of like in a quicksand. You don't know where your bearings are. You don't know exactly where you know your safety point is. You kind of get lost. All right, you just broke your rule there, so what do? Now you stick to your broken rule, or you correct that, and then you second out that because you still think about maybe you should correct it, so you go back to what you originally have in your trading plan. Then you correct it, but then it would have been good to stay in anyhow, so you might break your rule a second time. You know, once you do that, it could kind of get nasty, and it could go into this annoying circle of self-doubt, what to do, insecurity, unsureness, and stuff like that. That could be a big trouble. And revenge trading as well. Revenge trading can be based on many things. One of those is breaking your rules, but obviously emotions are high, and we just, especially with risk management, I mean, that is the biggest problem, the biggest reason I would say, I think Nana would agree with me, is just breaking our own risk management rules. That is probably, on average, I would say the biggest reason why traders, we lose larger parts of our trading capital. And if we could just not break that one already, it would, on the long run, would have a good impact already. I mean, if we avoid losing, if we just stick to it, and if our rule is not to lose more than 5% in a month, for instance, and that's quite conservative, but it's a sturdy rule. I think that the advantage of that is that you don't have much downside in the month. You got to chop up your risk in very small parts, of course, so you don't want to necessarily bump into that 5% at the end of the first week. That would be annoying to sit on